Stephanie is not going near AppLovin.
I am not going near.
But you continue to buy more Eaton and Quanta services. Why so?
Because I still very much believe in the whole data center build out. I still very much believe in the grid upgrade, and we haven't spent money on the grid in over 50 years, incremental money at least. I still think that's going to be powered by AI. So AI, data center, grid, and then power overall. Those are the themes that I like very much. And Eaton reported data center growth of 45%. Their orders were up 75%. They're talking about $1.7 trillion in mega project spend over the next several years, and only 15% have started. So haircut that. Even if you want to haircut it by $1 trillion, you still have a lot of momentum, and they have long-term contracts, and they have very steady and stable customers. Over 70% of their customers are utility companies. So I think the stock being down as much as it is, trading at a discount to its historical average, I think I'm just going to continue to buy. I've been wrong. It goes down every day, but I still like the theme, and I still like their execution.
So let me ask you this. So when you say that you still believe in the AI story, in the beginning part of 2000, you could say, well, I really believe in the internet story. And when you had, in May of 2000, I guess, when you had the crash, you could say, well, I still believe in the AI story, and the stocks continued to go lower because they went up in such a ridiculous fashion that it just wasn't justified.
Well, the companies weren't earning anything. That's the difference. Companies are earning, and we talked about this last week. Broadcom, that was the best semiconductor company, and absolutely focusing on AI. I know it's a diversified company, but AI is exactly what they thought it was going to be, a total addressable market, or a serviceable addressable market of $60 to $80 billion between now and 2027. And they are signing up custom ASIC customers more than people thought. And so if they're doing that, AI still is very much in the early innings, and this company earnings, I think earnings power is like $11, $12 a share. That's what's different than 2000. Companies were not earning money, and you couldn't really focus on earnings power with any kind of clarity or confidence.
But you could still look at a lot of these names and suggest that they were dramatically overpriced because all the hype around AI.
Yeah, you're right. Well, look, we talked about the multiple and how Broadcom is just the example I have because it's the only semi I own, but it went from 14 times a couple of years ago to 34 times. I wasn't buying it at 34 times. The stock now has come back to 26 times. Still not cheap, but I just think after the earnings report last week gave me so much more confidence in the earnings power story. And it's not just AI also. It is also VMware, software, and the legacy businesses that are troughing at this moment.
But like look at Quanta Services, for example. Yep. You know, you go from, let's throw the, I don't know, a 1 year. You go up to 365 on that name, and now you're down to 236.
Right.
What's the right stop point? How do we know?
It was up 40% last year. You're right. I don't know, but I can look at the numbers and I can look at what they're delivering and thinking that the pullback is overdone, and it's an opportunity. EBITDA grew 40% year over year. Backlog up 14% year over year. Long-term contracts with the utility companies are actually going a lot higher. And so to me, the numbers speak for themselves. The trends, the total addressable market and the trends that they're involved in have a long way to go, Scott. Does it go down another 15, 20% from here? Maybe it does. But I think in the next 3 to 5 years, it's going to be a winner, and it'll be a lot higher than where it is today.
You get a lot of credit for putting your money where your mind is, I'll tell you that, because you bought more Bank of America. After Friday, you told me you bought more Wells.
Yeah.
If you want to look at where the most acute pullbacks have been in the so-called recession trade, financials are coming off their worst week since March of 23. So again, you did Wells on Friday. Now you bought more Bank of America, which you told us right before we came on the air. Tell me more.
Yeah, well, so the stock is down 14% from its high. So well put in terms of the correction. Wells Fargo also down a lot as well. But I do think that trading at 10 times forward estimates, when the long-term average is 12 times, 1.1 times book, when the long-term average is 1.4 times book, you're getting value. I like the capital markets business. I still like the capital markets business. I still like M&A. I think it's going to work, but it's going to take longer than we expected. But the most important is net interest income, which is 58% of their total revenues. That actually is troughing, and I think you're going to see better net interest margins. And oh, by the way, in earnings, we have seen earnings revisions lower in a couple of sectors, like the tariff-rich sectors, right? Autos and aerospace, personal care as well. One area that actually numbers are not going down is financial services. So one name that did go down, and that was American Express, and I sold it, and I used the gains that I had to be buying some of these other companies within banks where I see better value.
Surat, the 1 month declines in the financial stocks is pretty telling. Citigroup's down 15, Morgan Stanley 14, Goldman and Wells 13, Bank of America 12, and JP Morgan 11. That doesn't even get into the private equity names, which have reset even more dramatically, well into correction territory for almost all of those names. But you've got a lot of exposure. Bank of America, Blackstone, Citi, JPM, Morgan Stanley, Prudential, Broadridge.
Look, I think when you look at these companies, look at a Morgan Stanley, you look at JP Morgan, Bank of America, you also have very strong fundamental wealth businesses. And you're not getting enough credit for those because that's where people are calling their advisors saying, where do I put my money? How do I make money? Whether it's I'm in different products like the Blackstone products or KKR products, net interest margin is going to be better. And these stocks have sold off for the two fundamental reasons. One is rates come down, financials get hurt. And secondly, a short-term blip on any M&A or capital markets activity, which I do think is going to pick up in the future. So people are, again, taking money off, but fundamentally and valuation-wise, these companies are cheap. They've got strong balance sheets and dividends.
I mean, discretionary has gotten crushed. It's by far the worst sector year to date. Airlines, anything consumer sensitive is getting hit yet again. United Airlines price target got bumped down. Chipotle, you bought more of that. Part of the story here.
It's back to where it was when the CEO left the company. It's ridiculous. This company is growing mid-single digit same-store sales. I think they have pricing power, substantial pricing power to offset the tariffs. That's going to hurt, and that's why the stock is actually down. They've got new products. They've got a great management team, and I think down 25%. Trades expensively at 25 times EBITDA. I'm not going to tell you it's cheap, but relative to its historical average, 38 times EBITDA. So I think you're getting best in class on sale, down 25%. And I just think that there's an opportunity there.